Paul has some money that he wants to invest, but the question is, what to buy? Paul isn't looking for an investment that will grow quickly. He is worried that kind of investment will expose him to a lot of risk. He wants something relatively safe, which will give him a steady income and will eventually give him his money back. Paul talks to his advisor, who suggests that bonds would be the right way for Paul to go. Paul looks at the bond market and immediately notices that if he buys the safest bonds, then his returns will be very small. Paul goes back to his advisor for some help. His advisor tells him he has a choice. In order to get a higher return, Paul needs to take more risk by investing in bonds that aren't as sure to be repaid, or tie his money up for a longer period of time. This is not really the answer that Paul was looking for, and he decides to do some more research. Paul looks at the bond market again and notices that the prices of bonds with a longer time left to run move around more than bonds with shorter maturities. Paul goes back to his advisor and asks why. His advisor tells him that the thing that is making the prices of the bonds move the most are changes in interest rates, and that as interest rates change, the prices of bonds with 20 years left will move a lot in comparison to bonds with only a couple of years left, whose prices hardly move. Paul begins to build a strategy. If he selects bonds with a shorter time to maturity, the prices of the bonds will be less volatile, and he should also have a better feeling for whether or not the money will be repaid when the bonds mature, even if he takes more risk by choosing an issuer that isn't the safest in the market. Confident in his strategy, Paul goes back to his advisor and asks him to suggest a bond that Paul can buy. His advisor tells him that buying only one bond would be more risky than buying a large basket of bonds. A large basket of bonds would provide diversification, which is essential for reducing investment risk. However, Paul only has enough money to buy one or two bonds. His advisor tells him to buy units of a bond fund instead. Paul's criteria for selecting a bond fund are quite specific by this stage. The fund should invest in a diverse portfolio of shorter maturity bonds issued by higher risk issuers. This kind of fund should be able to provide a more attractive income but with lower price volatility. He invests in an emerging markets short-term bond fund from Threadneedle and starts to receive income from the fund. In time, interest rates rise. However, the value of the fund remains stable through a combination of a lower sensitivity to interest rates and careful management of the portfolio by the fund managers at Threadneedle, and the income continues to flow. Paul smiles and checks his fishing line, comfortable in the knowledge that his money is exactly where he wants it to be. In summary, the current low interest rate environment means that bond investors have to take more risk in order to gain an attractive return on their invested money. The current low interest rates also present a risk that if interest rates and inflation rise in the future, then bond prices may fall and portfolios could suffer losses. Therefore, investors need to keep the maturity of their bonds short, and they need to invest in a diversified range of higher-risk bonds. Investors can access a wider range of higher-risk short-term bonds while benefiting from the protection that diversification and expert management provide by investing in a fund like the Global Emerging Markets Short-Term Bonds Fund from Threadneedle.